Inventories. Inherent risks must be dealt with by the economy not only through economic speculation, but also by maintaining inventories. Put differently, inventory is a substitute for knowledge. No food would ever be thrown out after a meal if the cook knew beforehand exactly how much each person would eat and could therefore cook just that amount. Since inventory costs money, a business enterprise must try to limit how much inventory it has on hand, while at the same time not risking running out of their product and thereby missing sales. Japanese automakers are famous for carrying so little inventory that parts for their automobiles arrive at the factory several times a day to be put on the cars as they move down the assembly line. This reduces the costs of carrying a large inventory of parts, and thereby reduces the cost of producing a car. However, an earthquake in Japan in 2007 put one of its piston ring suppliers out of commission. As the Wall Street Journal reported, for want of a piston ring costing $1.50, nearly 70% of Japan's auto production has been temporarily paralyzed this week. Having either too large or too small an inventory means losing money. Clearly, those businesses which come closest to the optimal size of inventory will have their profit prospects enhanced. More important, the total resources of the economy will be allocated more efficiently, not only because each enterprise has an incentive to be efficient, but also because those firms which turn out to be right more often are more likely to survive and continue making such decisions, while those who repeatedly carry far too large an inventory, or far too small, are likely to disappear from the market through bankruptcy. Too large an inventory means excess costs of doing business compared to the costs of their competitors, who are therefore in a position to sell at lower prices and take away customers. Too small an inventory means running out of what the customers want, not only missing out on immediate sales, but also risks having those customers look elsewhere for more dependable suppliers in the future. As noted in Chapter 6, in an economy where deliveries of goods and parts were always uncertain, such as that of the Soviet Union, huge inventories were the norm. Some of the same economic principles involving risk apply to activities far removed from the marketplace. A soldier going into battle does not take just the number of bullets he will fire, or just the amount of first aid supplies he will need if wounded in a particular way, because neither he nor anyone else has the kind of foresight required to do that. The soldier carries an inventory of both ammunition and medical supplies to cover various contingencies. At the same time, he cannot go into battle loaded down with huge amounts of everything that he might possibly need in every conceivable circumstance. That would slow him down and reduce his maneuverability, making him an easier target for the enemy. In other words, beyond some point, attempts to increase his safety can make his situation more dangerous. Inventory is related to knowledge and risk in another way. In normal times, each business tends to keep a certain ratio of inventory to its sales. However, when times are more uncertain, such as during a recession or depression, sales may be made from existing inventories without producing replacements. During the third quarter of 2003, for example, as the United States was recovering from a recession, its sales, exports, and profits were all rising. But Businessweek magazine reported that manufacturers, wholesalers, and retailers were selling goods off their shelves, and the ratio of inventories to sales hit a record low. The net result was that far fewer jobs were created than in similar periods of increased business activity in the past, leading to the phrase "a jobless recovery" to describe what was happening, as businesses were not confident that this recovery would last. In short, for sellers, the selling of inventory was a way of coping with economic risks. Only after inventories had hit bottom did the hiring of more people to produce more goods increase on such a large scale as to make the phrase "a jobless recovery" no longer applicable.